Welcome to an Introduction to Economics, brought to you by Parkbench Tutors and narrated by David Hopcroft. For further information about Parkbench Tutors, please visit parkbenchtutors.com. This podcast is about the factors of production. National income is viewed as income that is shared between labour, land and capital. How are the relative shares determined? We shall examine this briefly in this podcast. Labour, land and capital are the three factors of production. There are two main approaches to distribution. The first is functional and says that price is determined by supply and demand. This has led to the marginal productivity theory. The second is a personal approach that attempts to measure the inequalities of income and wealth. The 19th century economist Ricardo identified three classes. These were landlords, labourers and capitalists. Landlords receive rent, labourers receive wages and capitalists receive profit. Rent and wages represent the cost of production and what remains is profit. Ricardo defined a wage rate that represented subsistence, which he determined to be the customary standard of living. If there is a rising population, then demand for land increases, so rents are raised. If wages are being kept at subsistence level, then capitalists will experience a falling rate of profit. We have focused on marginal productivity theory, where all factors make a contribution to production and should receive a payment equal to the marginal contribution. An American economist, Clark, suggested that the aggregate production Q was a function of both labour and capital. With perfect competition, labour and capital pay the value of marginal products. We saw this in the idea that a firm will employ labour up to the point where marginal product of labour is equal to real wage. Thus, delta Q divided by delta L equals W divided by P. If the marginal product is greater than the real wage, then the firm will hire labour. If the marginal product is less than the real wage, then the firm will lay off workers. Marginal productivity theory suggests all factor units should be paid the value of the contribution made by the last unit employed. This is a value judgment of a fair and just reward. If all factors are paid the value of their marginal products, then there should be no residual value left. This proposition was put forward as Euler's theorem, in the form that the aggregate quantity should equal the product of the marginal product for labour and units of labour, plus the product of the marginal product for capital and amount of capital. An attempt to test marginal productivity theory on an empirical basis was carried out by two American economists, Cobb and Douglas. They proposed that the aggregate quantity should equal a constant A multiplied by the share of labour to the power D times the share of capital to the power of 1 minus D. Their results suggested a constancy in the share of labour and capital over a number of years, and other Western countries have been shown to produce similar results. An implication of these results is that capitalists will cut back on labour to maintain profit. However, in the post-war years there has been a trend for the share of wages to rise. How is the rising share of wages explained? Among the suggestions have been that the public sector has been steadily increasing in size, that there has been a decline in the number of those who are self-employed, and that technical progress has produced labour-saving devices that has led to increased productivity. Other criticisms on the weakness of the theory are that it assumes that all units of labour are homogeneous, which is hardly true if we are comparing a doctor and a welder. It also considers the use of capital based on historical cost rather than current value. How does technological progress affect income? There are a number of ideas that have been expressed. Marx was convinced that technology led to rising unemployment, with a fall in wages, and would eventually lead to a conflict between labour and capital. Others suggest that some technical progress leaves the ratio of labour and capital unchanged, which they term neutral, and distinguish this from labour-saving progress, which is non-neutral. When we consider the reward for factors, economists make use of the term rent. Rent is regarded as the reward for the service of land. An economic rent is a payment needed to keep a factor in current use. It is important not to confuse the use of the word in economics with the idea of rent being paid on an apartment in a shop. From Ricardo's viewpoint and that of classical theory, the supply of land is fixed, and there is an inelastic supply. This is shown by the line SS, where this intersects the demand curve DD at point E is the equilibrium point for rent, OR. If the population increases, then demand for land increases, and the new equilibrium point is E1, where the supply curve and the new demand curve D1, D1 now intersect. This shows a higher rent of R'. The rent has increased from R to R'. This argument fits well with increased demand for land in city centres. It is not quite as useful where land as a resource represents oil or some other commodity that is clearly limited in its supply. Such resources will eventually become exhausted. Where rent is the surplus over the cost of keeping land in its present use, it is termed economic rent. We need to understand two terms here. Transfer earnings are the payment required to keep a factor in its present use. Economic rent is any payment in excess of transfer earnings. A doctor may earn £100,000 in private practice or £60,000 working for the health service. The £60,000 represents the transfer earnings, and the difference of £40,000 is the economic rent. The map shows the demand and supply curves plotting quantity of a factor against price. The total earnings are given by O, P1, E, Q1. The area O, S, E, Q1 now represents the total transfer earnings of the factor. The triangle SPE represents economic rent. If a firm buys a factor in a perfectly competitive market with a perfectly elastic supply curve SS, then the total earnings are all transfer earnings. We reach this conclusion because if the price were to be below OP1, then the firm could not purchase any of the factor. We have, however, mentioned that labour is not homogeneous, so the supply is inelastic. Consider a machine which has only one use. Looked at in the short term, then all earnings are economic rent and there is no transfer earning. However, in the long term, the machine has to be replaced, so some economic rent should become transfer earnings. Note that accountants depreciate a machine to show the expense of using it. Most factors of production are in fact heterogeneous. A car and a truck cannot be substituted for each other. We sometimes say that profit is the reward of capital and that interest is the cost of capital. If money is used to invest, say in equipment, then the interest that could have been earned on the money is the opportunity cost. The neoclassical model has perfect competition, so the cost and reward of capital are equal to the marginal product of capital and there is no surplus. There are now two competing views, one assuming that capital can be regarded as homogeneous, the other suggesting that it cannot. In the classical theory, the price of capital, the interest rate, is determined by the supply of loanable funds. The map illustrates that the more resources there are being used for capital goods, the less resources there are for consumer goods. The neoclassical theory also says that the higher the interest rate, then the greater will be the amount for loanable funds. More individuals are willing to save at higher rates. Let us consider the demand for loanable funds. As interest rates rise, the demand for funds will fall. Let us consider what happens at a fixed interest rate. At first, the demand is high. The firm will also be looking at the expected rate of return, and here the law of diminishing returns will come into effect. At the point OL1, the expected rate of return is equal to the market rate of interest. After that, the return would be less than the interest rate, so the investment may not take place. If total demand from all firms is plotted against the interest rate and the supply of loanable funds is plotted against interest rate, then we reach an equilibrium point. An increase in savings should now shift the curve to the right, lowering interest rates and increasing the demand for loanable funds. Several problems have been expressed with the neoclassical theory. They include the suggestion that saving may be for a particular purpose, so not dependent on interest rates. There's also a difficulty in measuring capital. Perhaps the most significant is the idea that lowering interest rates gives greater investment. In the current economic climate, many savers have simply ceased to save because of low rates, thus limiting greatly the amount of loanable funds. Interest rates are also artificially held down by government intervention, so this also complicates matters. Small businesses, in particular, have complained about the lack of loanable funds in spite of low interest rates. There is an alternate view about capital and interest rates. There is a demand for capital as interest rates fall from I2 to I3. Beyond this, it is believed that there is a degree of re-switching, particularly in countries where labour is cheap and abundant. This ends our podcast on factors of production, brought to you by Parkbench Tutors and narrated by David Hopcroft. Thank you for watching and for listening. We wish you success in your studies. For further information about Parkbench Tutors, please visit parkbenchtutors.com.